Okay, good afternoon. Jeremiah Conjure here from Annuity Association, and today we're bringing back another exciting unbiased annuity review. Today we're going to be discussing the F&G Accelerator Plus 10 fixed indexed annuity. Now, this is a fairly recent product offering from F&G, very interesting in the way that it's structured in regards to giving the opportunity for safe growth, but also giving a very attractive guaranteed income with the potential for increasing income based on the performance of the underlying index strategies found within the annuity. So today we're going to be taking a deeper dive to break down the features, benefits, rates, and more of the F&G Accelerator Plus 10. And if this is the first time that you're tuning in and watching a review of ours, well, first off, thank you for watching. Secondly, the premise and mission of Annuity Association is to really bring more transparency to the annuity buying process for you, the end consumer, to ultimately help you make an educated decision on which annuity is right for you and which product specifically is going to help you achieve your goals and objectives moving forward for retirement planning. So if this is the first time you're watching, we're going to take a deeper dive into the product brochure. We're going to uncover all of the features and benefits of the F&G Accelerator Plus. And then later on in the review, we're going to take a look at our software to get a better understanding of the specific index strategies that are offered in this annuity and take them through a back testing exercise to see how they would have potentially performed if we owned this contract during the last 10, 15, and 20 years. So before we get started, just like to say thank you for watching. If you get some value out of this review today, please do us a favor and give us a thumbs up or a like. And maybe you have some friends and family that could benefit from this information as well. We'd appreciate you sharing the video to get this spread across many different social media platforms to help our video get ranked, to help others find the information they're potentially looking for. Just want to also, share a bit of gratitude and say thanks for tuning in. And it's really been quite amazing what we've been able to accomplish here this year regarding these annuity reviews that we started to conduct. Again, speaking to the mission of bringing more transparency to help ultimately, the consumers make an educated decision on which annuity is right for them. The feedback that we've received has just been amazing. Everybody's had nothing but positive things to say. And, everyone from prospective clients to current clients, as well as even advisors, have been reaching out to us and sending us, kind words and showing their gratitude for what we're doing. So, I never anticipated that these reviews would get that type of feedback. So I'm just thankful for the opportunity that we have to be able to spread this information across the various social media platforms. Also, this looks to be the first time we are broadcasting live on LinkedIn. So shout out to LinkedIn. If you're watching here, give us a like. I'm very excited to be on this platform. It took forever to get approved to do live broadcasts. So I just happened to click the button. I didn't even know we were approved yet, but it looks to be broadcasting. So hopefully you can hear us and see us. I did double check and make sure that I wasn't on mute. I just tried to record this review about 10 minutes ago. And about 10 minutes into the review, I realized that I had been on mute the whole time. And if you've watched any of our previous reviews, I've done that once or twice before. And I always said I'd never do it a third time. And look what happened. It happened. So wasn't paying attention, and that's on me. So anyway, so let's go ahead and get this legal stuff out of the way. We're going to share our disclaimer real quick, and then we'll dive into the product brochure. And then later on in the broadcast, we'll be taking a look at our back-tested exercise to show these index strategies and how they would have potentially performed over the last 10, 15, and 20 years. And then last but not least, if we have some time left, we'll take a look at an example illustration to help you get an understanding of how this annuity would look on a ledger. So I'm going to go ahead and share my screen. If you haven't done so already, you can enlarge your viewing window by clicking the bottom right-hand corner of your screen to enlarge the window. Again, we're talking about the F&G, or Fidelity and Guarantee Accelerator Plus 10 fixed indexed annuity. This is an unbiased, independent review brought to you by Annuityassociation.com. This is a review, not a recommendation to buy or sell an annuity. F&G has not endorsed this review in any way, nor do we receive any compensation for this review. This review is meant to be an independent review at the request of website visitors so they can see our perspective when breaking down the positives and negatives of this particular annuity. Before purchasing any investment product, be sure to do your own due diligence and consult a properly licensed professional should you have specific questions as they relate to your individual circumstances. All names, marks, and materials used for this review are property of their respective owners and not that of Annuityassociation.com. While care has been made to ensure this review is complete and accurate, no guarantees are made to the completeness or accuracy. Okay, so since we're a few minutes behind on our schedule here, I'm going to go ahead and just dive right into the review. This is the product brochure for the F&G Accelerator Plus 10 fixed indexed annuity. The Accelerator Plus 10 is a dependable growth offers dependable growth potential, a vesting bonus, and options for guaranteed income, along with a death benefit to provide a legacy. The Accelerator Plus 10 helps you maximize retirement income with guaranteed payments for life, preserve your savings with index growth potential and no downside market risk, and leave a financial legacy with a death benefit for peace of mind. So who is F&G? F&G since 1959 has been the silent, unseen enabler of the hopes and dreams of millions of Americans. Today, F&G provides annuities and life insurance for over 700,000 people across the United States, and the people who hold their policies were introduced to them by someone they may know, whether it be their financial or insurance professional. F&G collaborates with them to be partners in prosperity with you and the people you care about the most. Working together, F&G becomes something greater along with you as a partner. We become agents of possibility, agents of empowerment, agents of stability and security in a volatile world. We work together, think together, succeed together, and collaborate to help you prosper. That's a great message. F&G, obviously is very customer centric. They're a joy to work with, both from a client service perspective as well as an advisor service perspective. They are an A- rated company from AM Best, and very, again, customer centric in regards to, the way they support their current clients and potential clients in the future. So what is an annuity? An annuity is a long-term retirement tool that can be a cornerstone of your financial security and success. You pay a premium, think of it as your principal, to F&G, and F&G provides an annuity contract with unique benefits to you. An annuity protects and potentially builds your savings with the option of converting them into scheduled income payments for retirement. If you're interested in an opportunity to grow your savings based on a market index without the risk of actually participating in the market, a fixed indexed annuity may be a good choice for you. This quick reference guide is intended to provide a helpful overview of the Accelerator Plus 10. It is coupled with the Statement of Understanding, which will be referred to you moving forward as the SOU, that explains this annuity in detail. The SOU contains product information that is important and specific to you and to give you an understanding of this annuity. If you decide to complete an application, your financial or insurance professional will ask you to sign an acknowledgement to confirm you've received and read the SOU. In the event of any conflict between this guide and the SOU prevails. Your financial or insurance professional is able to explain the benefits and restrictions that apply in your state. Read on and learn more about how the Accelerator Plus 10 can play an important part in your financial security. So is the Accelerator Plus 10 a good option for you? The Accelerator Plus 10 protects your savings from market risk while potentially giving you market-based growth with tax-deferred earnings. It is a long-term retirement planning product with these important features. So the Accelerator Plus 10 is going to give you a bonus to your account that vests over 10 years. We'll be taking a look at what that specific bonus amount is here momentarily, so stay tuned. And you can choose from several options for earning interest on your premium. One fixed interest option with a guaranteed rate, and additional options tied to market indexes. Any growth of your savings is tax deferred. You pay taxes only when you make withdrawals or receive income in the future. You have the option of guaranteed income for life, and you'll have full access to your account for unexpected healthcare costs, namely qualifying nursing or home health care, or in the event of terminal illness. This benefit applies to conditions that arise 1 year or more after the contract begins. From day one, you have benefits, death benefits for peace of mind, and you may withdraw your money at any time. Withdrawals in year 1 or withdrawals in years 2 through 10 of over 10% of your vested account value will incur withdrawal charges. So let's talk about the growth potential. So the premium you pay in the first year grows with a vesting bonus. The vesting bonus is currently 5% for ages 0 to 75 years young and 3.25% for ages 76 and above. In the following states, the vesting schedule is going to differ slightly. I won't read all those states off, but if you see yours listed and you'd like to know the specifics, you can go to annuityassociation.com. Right there on the main page, click the green button to request your free report, and I'll reach out to you in a timely fashion to see how I can help point you in the right direction in that regard. F&G adds a percentage of this vesting bonus to your account each year for 10 years, and you may add more premium later if you like, increasing the amount of premium that may grow over time. And your choice for tax-deferred growth. You choose any combination of these potential interest earning options. A fixed interest option, which is the rate is set annually, and it's guaranteed to never be below 1%. And then there are several options tied to market indexes. The first one being Barclays Trailblazers Sectors 5 Index, the Balanced Asset 5 Index, and the S&P 500 Index. Each index option is subject to caps, participation rates, and/or spreads, and the index options are linked to a market index, but you are not investing directly in the stock market or any index. F&G protects you from downside risk, and you are guaranteed not to lose money to market declines. Each index option is available with or without a rider charge. Index options with a rider charge may provide higher caps, participation rates, and declared rates, or lower spreads than options without rider charges. The rider charge is currently 1.25% of the options account value, and at the end of each crediting period, any gains are locked in. The index options are not available in all states, so please check with your financial or insurance professional. So this product basically is going to offer what's called a performance enhancement rider. It's optional. If you elect to add the rider, you're going to get a higher participation rate or a higher cap rate on the underlying index strategies that essentially just going to give you higher growth opportunity moving forward. You can also elect to not add the performance enhancement rider, which again, there would be no fee for that. And it just means that you're going to have lesser rates that are offered on the underlying index strategies. So we'll be taking a look at that here momentarily to see what the difference is between adding the rider and having it without it, to see how much of a difference it really makes when back testing these index strategies over the last few years. So here are some of the key benefits. Guaranteed income. So the Accelerator Plus 10 gives you the option for a fee to receive scheduled income for life as guaranteed withdrawal payments. If you haven't made excess withdrawals in any year, payments will never run out, no matter how long you live, even if your account value is depleted. So with this product, you're going to get that guaranteed income rider. It's going to ensure that regardless of what occurs on the accumulation value of the account and how those index strategies perform, if you elect to have the guaranteed income, regardless if that account eventually goes to zero and is depleted, your income will never cease. It will continue on, and you can structure that for single life or joint life to cover you and your spouse. You may begin guaranteed withdrawal payments anytime after the first contract year if you are at least 50 years old. The time to start is up to you, and you may stop income payments and restart them later. The payment amount is determined by the income base of your account at the time you begin withdrawal payments, and the income base is different from your account value and cannot be surrendered or withdrawn. Your guaranteed withdrawal payments may increase if you become impaired to the extent you are unable to perform at least 2 out of the 6 activities of daily living. These are defined terms and may vary from state to state. Increased payments will continue until your account value is depleted or the impairment no longer qualifies you for the benefit. Payments then revert back to the guaranteed withdrawal payment. Prior withdrawals reduce guaranteed withdrawal amounts moving forward. You also will receive a death benefit. So one of the biggest misconceptions of annuities is that if you pass away, the insurance company keeps your money. It's entirely false. There's only one type of annuity structured in one particular manner that would ever be the scenario. In these types of annuities, they are going to have a death benefit that will always match the account value or the accumulation value, and those monies will be paid to your designated beneficiaries listed in the contract and avoid probate. In addition, they will avoid those surrender charges or early withdrawal charges if you happen to pass away during the surrender charge period. So there's your peace of mind for that. Your account value is paid as a lump sum death benefit to your designated beneficiaries. And the Accelerator Plus 10 offers that peace of mind that we're also longing for in retirement, and that is access for unexpected healthcare cost. If you need home health or nursing home care, or in the event of terminal illness, you may access your account value with no surrender charges or market value adjustments. The diagnosis of terminal illness or the beginning of home health or nursing home care must occur at least 1 year after the contract is issued. These are defined conditions, and this benefit may vary from state to state. You also have the ability to withdraw. You may withdraw your money at any time. We know you may have unexpected opportunities or expenses in the future. You'll have penalty-free access to 10% of the invested account value in years 2 through 10, and any other withdrawals will incur surrender charges and market value adjustments. The surrender charge in contract year 1 is 14% of the withdrawal, and this percentage decreases each year for 10 years. Again, the following states follow an alternative surrender charge schedule. So if you see yours listed there and you'd like to know the specifics, just reach out to me directly. In these states, the surrender charge in contract year 1 is 9% of the withdrawal, and this percentage decreases over 10 years. So if you're not familiar with the surrender charge, basically what that means is first off, the annuity is going to offer a free withdrawal provision. Generally, they're up to 10% during the surrender charge period, and any withdrawals that exceed that 10% in any calendar year will incur a surrender charge or early withdrawal charge or penalty. It's going to differ by product, and each year that penalty will reduce over time, eventually going to zero once you've fulfilled that 10-year surrender period in this specific product. So if you have additional liquidity needs, rest assured you can still access the money. Just keep in mind that there will be a surrender charge charged to any withdrawals above and beyond the free withdrawal provision of 10%. And last but not least, annuitization. You don't have to worry about outliving your assets. You always have the option of annuitizing your contract, which means turning your annuity into scheduled payments for life. If you keep your contract until its maturity date, you must annuitize it then. The maturity date of your Accelerator Plus 10 contract is set when the contract is issued. So like all annuities, they do have the ability to annuitize the contract value in exchange for a lifetime payment or a period certain payment. Now, when they talk about the maturity date, that's not the 10-year period that they're referring to. The maturity date is usually much later in life. Generally, I don't see them anytime until the person has gotten into their 90s most of the time that's set in the contract. So usually it's like age 90 or 95. I've seen 99 before. So all that means is if you were to hold this contract for that long, there will be a maturity date, which then would require annuitization. But rest assured, you're going to get plenty of communication during that time frame to let you know when that maturity date is approaching, and you can make the proper changes should you choose to avoid the annuitization. Annuitization is it used to be a common occurrence in terms of people utilizing that in exchange to receive a lifetime payment. But and nowadays, these fixed index annuities offer lifetime income riders, which act as a form of annuitization in the sense that you're exchanging the rider charge for a guaranteed payment, but you still maintain control over the account value or the accumulation value, so that in the event you do have additional liquidity needs down the road, you still have access to that account value. If you annuitize it, the difference is you exchange that contract value for that payment, and you no longer have control over that account value any longer. So hope that makes sense. So let's briefly discuss some of the tax information. The annuity is tax deferred, which means you don't pay taxes on the interest as it's earned, only when you withdraw it. Tax deferral may not be available if the annuity owner is an entity such as a business. Withdrawals are treated as coming from earnings first, which are taxable, and then as a return of your premium. If you withdraw money before age 59 and a half, you may also pay a 10% penalty to the IRS. Please keep in mind that buying an annuity in an IRA or other tax-qualified retirement account offers no additional tax benefit. And since the retirement account is already tax deferred, it just doesn't give you any additional benefits there. If your annuity contract is within a tax-qualified plan, you may be required to take minimum distributions beginning at age 72. You may exchange one tax-deferred annuity for another without paying tax on the earnings when you make the exchange. And before you do, compare the benefits, features, and cost of the two annuities. You may pay a surrender charge on the annuity you are exchanging, and you may start a new surrender charge period with the new annuity. F&G does not offer tax or legal advice. Consult a properly licensed tax professional regarding your specific situation. So in the event you do, purchase this annuity and you use a qualified account, which is, very common and perfectly okay, whether it be a 401k or an IRA or some other tax-deferred account, tax-qualified account, and you approach age 72 at some time within that 10-year surrender, that's okay too. If you have to withdraw monies to meet your RMD or required minimum distribution obligations, you can do so within the annuity and not have to pay any penalty, even if you're within that first 10 years. So there's that peace of mind there to know that, and I hope that you make a note of that, because that's very important. There are no surrender penalties or early withdrawal penalties incurred, even if your RMD requirement exceeds that 10% free withdrawal provision. So keep that in mind. Okay, so that concludes the review of the product brochure. Now we're going to take a deep dive into our software and take a look at the specific index crediting strategies to see how they would have potentially performed if we own this contract during the last 10, 15, and 20 years. So our software here is going to take a look at every index strategy and reset period that's offered in the Accelerator Plus 10. And then it's going to take take it through a back-tested exercise to see how they would have potentially performed over these timeframes. In addition, it's going to give us the highest 10-year period over the last 20 years and the lowest 10-year period over the last 20 years to help give us a baseline of the best and potentially worst case scenario. Now, I must make the disclaimer that prior performance is not always an indicator of future performance. None of us have that crystal ball to know what these markets or index strategies are really going to do moving forward. But I do think that there is some value in understanding how they potentially would have performed if everything was created equal in terms of what's offered in the contract today from a participation rate perspective, as well as back testing it over the last 10 and 15, 20-year periods to give us an idea of what it could have done if we owned it during that time frame. Now, let's go ahead and take a look. Coming in first, these are listed in chronological order of highest to lowest average annualized rate of return using the 10-year column. So we'll see the first index strategy is the 1-year Cibc Balanced Asset 5. This is a point-to-point with participation rate strategy, and the participation rate at the time of this review is 155%. So if you're not familiar with indexed annuities or any of this lingo that I've used to this point, I'd like to break it down just as simply as I can. So when you're looking at an indexed annuity, they're going to offer various indexes. They're going to offer various crediting strategies and crediting periods. So we'll start with the first one. This is a 1 year, so that's the crediting period, 1 year point to point using a participation rate. So when you buy this annuity on the anniversary date or the issue date of your contract, you're going to receive your policy, and inside it's going to have the starting value of the index on the date your policy was issued. So in this example, they would be sending you communication on the CIBC Balanced Asset 5 Index. They'll give you the starting value of that index, and that would be essentially your starting point, okay? Fast forward a year to the anniversary date of having it for 1 year, they're going to send you communication again that's going to declare what the ending value was of the CIBC Balanced Asset 5 Index. This will be the ending point. So when you hear point to point, it's referring to the starting value and the ending value of the index for your 1 year crediting period, which is starting date to anniversary. And then whatever that growth was, if it's positive growth that was occurred during that time frame, then they're going to multiply the participation rate, which in this case is 155%, towards that index growth, and then that would be your credit to your contract or accumulation value. So in this example, the again, participation rate at the time of this review is 155%. So let's say the CIBC Balanced Asset 5 Index went up 10% for that 1 year. They're going to take 10%, multiply it by 155%, and that would equal an interest credit of a gross interest credit of 15.5%. So above and beyond what the actual performance was of the index itself. So I hope that I was able to break that down as simply as possible to give you a better understanding. Now, when we look at this specific index and we back test that strategy over the last 10 years from December 31st of 2010 to December 31st of 2020, we'll see that the average annualized rate of return is 10.07%. And then just below that, you're going to see a green and red number. The green indicates the highest 10-year or best 10-year performance over the last 20 years. And in this case, it's from December 30th of 2009 to December 30th of 2019. And that average annualized rate was 10.42%. And then on the other side, we have the red number, which is indicating the worst 10-year performance over the last 20 years. In this case, it's from December 30th of 2003 to December 30th of 2013. And we're looking at a 5.68% average annualized rate of return. Now, I do believe that this is a very good period of time to really assess, what this thing could potentially do during a very bad economic period. In this case, we're coming right out of the dot-com bust and then going in and through the global financial crisis of 2007 and 2008 and that lackluster 5-year period that followed that. And we're still coming out with a 5.68% average annualized rate of return during this back-tested period. Now, a lot of that is attributed because of the contractual guarantee of principal protection, meaning in any down years, your money is completely protected and shielded from market losses. You will never incur any negative interest credits to your account value due to market declines or market losses. So keep that in mind, that the main reason people look at fixed indexed annuities is because of the contractual guarantee that their money is safe and protected from market downturns. Now, this specific index strategy is utilizing the enhanced participation rider, which is giving us a higher participation rate because we've elected to add the rider for a fee, which in this case is 1.25%. Now, when we look at it over the last 15 years from December 31st of 2005 to December 31st of 2020, we'll see a 7.76% average annualized rate of return during that time frame. Now, just below it, we see the 2-year CIBC Balanced Asset 5. This again is a point-to-point using a participation rate, but instead of a 1-year point-to-point, it's looking over a 2-year period. Now, in this particular case, generally the rule of thumb is that the longer crediting period that you go with, generally speaking, the higher participation rate will be offered. And that is evident in this particular case. We're seeing the participation rate go up to 175% versus 155% in the 1 year. When we backtest that during the same time frame over the last 10 years, we see an average annualized rate of return of 9.79%. And the highest 10 years from December 30th of 09 to December 30th of 2019 at 10.24. And the lowest 10-year period, again, from December 30th of 03 to December 30th of 2013 at 5.69%. And the average over the last 15 years at 6.8. Again, this is utilizing the enhanced participation rider, which is a 1.25% annual fee, and it's giving us the higher participation rates. We'll be taking a look at filtering out that account fee here momentarily to see what the index back testing how that will perform without the enhancement. This product does also come in a 14-year version, which is the Accelerator Plus 14. And in that, they do offer a 1-year Cibc balanced asset index as well, with a 1-year point-to-point participation rate. And the participation rate at the time of this review is 150%. And we see that that performs at 9.75% over the last 10, 10.09 highest 10 or best 10, and 5.5 worst 10, and then 7.52 over the last 15 years. And we'll see the 2-year comes in as well at 9.53, 9.96 on the highest 10 or best 10, 5.54 on the worst 10, 6.61 on the average over the last 15. And then coming back in at the Accelerator Plus 10, we have the 2-year Barclays Trailblazers Sectors 5. This has been a very popular index for F&G over the last handful of years. They offer it within all of their fixed indexed annuities, and it's been a very good performer for them. And we'll see this 2-year Barclays Trailblazers Sectors 5, again using a point-to-point participation rate, is the participation rate is 155%. Again, it does include that enhanced participation rider 1.25. And then back testing it over the last 10 years, the average rate of return annualized is 8.9%, best 10 at 10.44, and worst 10 at 7%, and the average over the last 15 at 7.28. Now, we're starting to get into the index strategies without the performance enhancement rider or participation enhancement rider. We'll see the top strategy comes in with the Accelerator Plus 10, and that is the 2-year Cibc Balanced Asset 5. And that's a 7.68% average rate of return over the last 10, and 8% best 10, 4.46 worst 10, and 5.33 over the last 15. So let's go back up to that same 2-year to compare apples to apples, looking at the product with the enhancement on the rider. And we'll see 9.79 and 6.8 over the last 10 and 15 respectively. And if we come back down without the fee, we're at 7.68 and 5.33. So, that gives us about 2% on the, just about 2% on the last 10. So a difference of 2%. And then over the last 15, a difference with the rider giving us a higher growth potential of 1.5, roughly 1.5% over the last 15. So is it worth it to have the enhanced rider? I mean, yeah, there's an argument that it is. It just depends on, what you feel comfortable with. Sometimes people say, Jeremiah, I just don't want any fees. I don't want to worry about it. I just want it to be simple and easy to understand. That's perfectly fine. It's all about what you feel the most comfortable with. My job is just to educate you on the differences and help you make that educated decision. Okay, they do offer an S&P 500 option on the Accelerator Plus 10 and Accelerator Plus 14. Here coming in at the top for that specific index is the 1-year S&P 500 point-to-point using a monthly sum cap, and the cap is set to 2.75%. Now, this index strategy is a little different in terms of how it works. Because it's using a monthly sum cap structure, what they're going to do is over that 1-year period, they're going to take a look at each individual month and set a cap for that individual month. So the highest you could earn in any month is 2.75. Now, because it is a monthly sum or a monthly average, they're going to look over that 1 year. Now, negative months do impact the equation. If you have a down month, then that can also affect the overall average, and they're going to take a calculation of every single month and what the net performance was. You have a 2.75% cap, and then divide it over 12 months. So if you had negative performance, obviously your money's protected. You'd always have a zero as a credit, but it does still impact the overall equation for months that had down months or down performance. So with that being said, they're going to take a look at all 12 months and what the returns were, factor those in, and then they're going to come up with the average for that 1 year, and that would be your net credit. So using that formula and that crediting strategy, again, this isn't including the enhanced rider for growth, a 1.25% annual fee, and we're seeing the 7.14% average annualized rate of return over the last 10 years during this back-tested exercise. That also indicates as the highest, or identifies as the highest 10-year period over the last 20. And then lowest 10 years over the last 20 is from December 30th of 2001 to December 30th of 2011. And we're seeing a 3.19% average annualized rate of return during that time frame. That's a huge time frame there. 2 black swan events within that 10 years, the dot-com bust and the global financial crisis. So very good to see the value that guaranteed 0% floor and principal protection is adding during that time frame. Some people refer to that 10-year period as the lost decade because the markets had no growth for that entire decade. And you would still come out of it if you own this product during that time frame and everything was created equal in terms of what's offered in the contract. You would have had a 3.19% average annualized rate of return during that lost decade. During the last 15 years, we see that strategy at 5.4% and 5.14% over the last 20 years, respectively. So this annuity does offer a good opportunity for diversification within the index strategies that are offered themselves. So, for example, if you were putting in $100,000, you could put 33% in one index strategy, 33% in another, and 34% in the third index, and giving you a level of diversification that you're not putting all of your eggs in one index strategy. So it just increases the odds that you're never going to have a zero in any given crediting period. So I like that. It's something that I look for when I am making my recommendations. So I do like that about this annuity and think that that's a very positive attribute there. Now, one thing to note is that there is a required rider fee on this annuity for the lifetime income rider. So if you do purchase this annuity, keep in mind that it does require you to elect to have the guaranteed income rider or guaranteed lifetime withdrawal benefit rider. And that fee is 1.15% that's charged annually. So we'll see that rider fee right here at 1.15%. And it does include a 5% compounded roll-up rate on the income benefit. We'll take a look at that here momentarily. So we've broken down the brochure. We've broken down the index crediting strategies and taken them through our back-tested exercise. If you'd like to work with me directly and really take a deeper dive into this particular annuity so you can compare it to either one you own or another one that maybe you're thinking about purchasing, I'd love the opportunity to work together. We work with clients in all 50 states. You can visit our website at annuityassociation.com. Right there on the main page, click the green button to request your free report, and I will reach out to you in a timely fashion, and I would be thankful for that opportunity. Okay, let me go ahead and get the income calculator dialed up here for this product so we can take a look at that income rider and break that down for you. And then we'll, if we have a few minutes left, we'll take a look at the example illustration, see what that looks like. Okay. All right, let me make sure I got this up. Yep, there we go. Okay, thanks for your patience there. Okay, so we're looking at a hypothetical example showing us the guaranteed income on this particular annuity. We have the example that we're using in the data is a 60-year-old male in the state of Florida. The annuity is structured for single life income, and we're putting in $100,000 and deferring it over a 5-year period, turning income on year 6 of the contract. And we'll see that that's going to generate us a guaranteed annual income of $6,381. So that's our minimum that we could ever expect from the F&G Accelerator 10 with the guaranteed lifetime withdrawal benefit or guaranteed lifetime income rider. Now, how does that income get to that number? Very easily. There's a few numbers that go into the formula. The first one is going to be first off, the compounded roll-up rate, which is essentially an interest rate that's applied to the income benefit base. So when you buy an indexed annuity with a lifetime income rider, you're going to have 2 columns that are going to grow within the contract. And the way they grow are different. So the first exercise that I take my clients through is to take a piece of paper and write a large T or T chart on the paper. On the right-hand side, you have your income benefit or your income benefit base. Every company calls it something different, but those are the most common terminologies used there. And on the left-hand side of that T chart, you're at the top left, you're going to write contract value or accumulation value. Those are 2 synonymous words for the account value. And how that grows is according to the underlying index strategies that you're allocated to. Now, when you buy a lifetime income rider on an annuity, the right-hand side of that T chart, that income benefit, is going to grow according to what the contractual guarantees are for the rider. In this case, on the F&G Accelerator Plus 10, the rider is going to include a contractual guaranteed roll-up rate, which is compounded, of 5% annually. So that $100,000 that you put into the annuity on the right-hand side of the T chart is going to grow at 5% no matter what the markets do moving forward, because it's contractually guaranteed. That income benefit base is going to grow 5% each year you defer it. So it grows regardless of what the index strategies do. So you have the peace of mind that even if markets don't perform well moving forward, your income benefit has been growing according to that 5% guaranteed roll-up rate. Now, sometimes these annuities will offer an income-based bonus. In this particular case, it does not. The bonus that's offered in this specific product is actually added to the account value or contract value side of that T chart, so the left-hand side. So there's no bonus in here, but this product is going to grow according to that 5% compounded roll-up rate and can grow up to 10 years guaranteed. So if you defer it up to 10 years, you're going to maximize 5% compounded every single year on that income benefit base. So in this example, it's growing that $100,000 to $127,628 during that 5 years of deferral. And then the other part of that formula is what's called the payout rate or the distribution rate, which is only based on your age. If it's structured for joint, it's going to be based on the younger of the 2 people that it's structured for. And anyhow, in this case, at age 66, when this person in this example elects to turn on the income stream, that payout rate would be 5%. Now, again, that rider fee costs 1.15%, and it is required for this particular annuity. It is not optional. It is not like the enhancement rider that impacts the participation rates. That is optional. In this case, it is not. So in that example, too, if you did elect to add the enhancement rider for the participation and increased participation rates and enhanced cap rates on the indexing side, that would be in combination with the required rider for the lifetime withdrawal. So combined, you would be looking at 2.4% in total fees if you had both riders. If you don't add that enhancement rider, you just would be required to pay the 1.15% required fee for the guaranteed lifetime withdrawal benefit rider. So hope that makes sense. Now, if we were to go up and defer it, let's say to 10 years, so I'll show you how our calculator works, and then come back down and take a look, we'll see that now the guaranteed annual income has grown to $8,959, and that income benefit base has grown to $162,889. And because the person's older and electing to turn on income around age 70 now, the payout rate has increased to 5.5%. Now, one other thing to note is that this product, because it does include the accelerated or enhanced income payout or income benefit for nursing home care and long-term care needs, that doubles the guaranteed annual income amount. And in this example, it would double the $8,959 and pay out $17,918 a year for those nursing home or confined care needs. Okay, so we've looked at that. We've looked at the guarantee part of this annuity. One other area to break down is the opportunity for higher income based on how the product performs. So let's take a look at that as well. Bear with me while I get this dialed up here. Again, we're going to look at a male age 60 in the state of Florida with $100,000. And we're going to look at the hypothetical value for income based on how the index has performed potentially. And we're going to look over a 10-year deferral period in this example. So I'm going to share my screen here in just a second. Let me get this dialed in. Okay. So I'm going to go ahead and share my screen here again. Okay, so we're looking at, again, the F&G Accelerator Plus, and because of the unique structure of this particular annuity where it includes a higher guaranteed minimum lifetime income using the rider, it also offers hypothetical income that's based on the performance of the underlying index strategies. So what we're looking at here in this particular case is it's using the highest back-tested index strategy. In this case, it's the 1-year Cibc Balanced Asset 5 Index using the point-to-point with participation rate. The participation rate is 155%, and that's because of the enhanced participation rider of 1.25%. Now, if this index was to perform well over the 10 years of deferral, the hypothetical income based on that performance of the index could increase from that guaranteed $8,959 all the way up to $17,162. So this is a unique fixed indexed annuity for lifetime income in the sense that it gives a very strong guarantee, a strong guaranteed minimum. So if markets don't perform well, you've got it backed up by that guaranteed lifetime income minimum withdrawal amount because of the compounding roll-up rate found in the rider. But it also gives us upside potential that if the index does perform well during the deferral period, our income could actually be exceed that guaranteed minimum. In this case, it's showing $17,162. So we have a strong guaranteed floor with high upside potential. And I like that idea that, it's giving us kind of the best of both worlds. Now, this isn't the only annuity that offers a structure in that manner. So it's best to do your due diligence to compare all of them to make sure that you're getting the best one for your particular situation. And if you'd like to compare that annuity to another one out there, I'd love the opportunity to work with you. You can visit our website at annuityassociation.com. Right there on the main page, click your green button to request your free report, and I will reach out to you in a timely fashion to see how I can help point you in the right direction. Okay, last but not least, we're going to go ahead and dive into an example illustration on this guy. Let's go ahead and take a look at that. Let me get that dialed up here. Again, we're going to look at a male in the state of Florida, age 60, with $100,000. And we're going to look at F&G Accelerator Plus, since that is the review we're doing. So we've got Fidelity and Guarantee, Accelerator, plus 10. And then we're going to look at the top index strategy offered. And again, you can also, like I said, diversify within the different various index strategies. And our software breaks that down on which combination, or more than two, it could be 3 or 4, are going to give us the best opportunity for growth while also diversifying our monies within the annuity itself. So in this case, we're just going to look at the top index strategy when looking at the back-tested analysis. And we're going to look at turning on income age 65, since that's what we used in the example earlier. And now keep in mind, this is a flexible premium product for the life of the product, meaning you can add additional monies to it down the road. So if you're finding yourself as a self-employed individual and you're looking to contribute to a product that you can grow over time, this is one of the few annuities that will give you that ability to do that. And it does not require a huge lump sum to start. I believe, if I'm not mistaken, I'll double check it, but it's around 10 or 20,000 minimum as a starting premium, and then you can contribute over time. Now, in this example, we'll see $100,000 coming in year one. And let me back this out so we can see it. I had to minimize the screen a little bit, so hopefully you can maximize on your end to make it larger if you're having trouble viewing it. But we see $100,000 going in year one. We'll see that bonus combined with the $100,000 premium going into the account value column, which is the left-hand side of your T chart, which is your accumulation value, or also referred to as your contract or account value. So we'll see that end of year one, we have $109,390. We'll see that they're showing us our vested account value with that bonus in there. Again, that bonus is vested over time. And then we'll see our surrender value, which includes the surrender penalty if we were to exit early. And then our income benefit base, which is $114,860. That's the end of contract year one. And that's from the growing income benefit based on the roll-up rates and things of that nature. Now, because we're deferring it over 5 years in this example, you'll see the interest crediting rate is being applied. In this case, it's a 1-year point-to-point. And we're using the most recent 10 years back-tested using that index strategy. So we'll see we have 8.88% coming in the first year, 9.19% the second year, 12.59% the third year, 19.72 the fourth year, and then we see a 0 the fifth year, indicating that that must have been a down year when looking back over the last 10-year period. So there's just a 0 that's being credited for that particular year. Now we'll see the account value grows respectively from year 1 to year 5 from $100,000 to $144,891. And then we'll see that income benefit grows to $181,114 during the 5-year deferral, and also based on the index values growing. So we'll see that the income, hypothetically in this example, is up to $9,056, showing us the growth from the index, crediting our income base as well, giving us that higher hypothetical number. Now, if we go back up to the guaranteed portion of the illustration, we'll see that guaranteed minimum, assuming there's been no growth, you'll see on the interest crediting rate column, it's just showing zeros. That's assuming the index never grows. Your income is still going to be minimum $6,381 on that $100,000 after 5 years of deferral if you were a male age 60 in the state of Florida. Now, again, just a reminder that lifetime withdrawal rate, or what we refer to as the payout rate, does differ based on the age that you turn it on at that time. So in this case, the payout rate is increasing to 5% when the person turns age 65, since that's the age they'd be when they turn on the income. To the far right, let me back up a little bit. There we go. I had to minimize it just slightly so we can get all the columns on the screen. We'll see the rider fees being charged. That is that 1.15% for the guaranteed withdrawal benefit, as well as the 1.25% fee that's being charged for the for that enhancement rider on the index strategy. Last but not least, you'll see the death benefit column always matching the account value column every single year, even during the surrender period, which obviously does not incur any surrender charges if you were to pass away within the first 10 years of holding this contract. Last but not least, you'll see the vested account value column, which is just right of the account value column. That's showing the bonus, and you'll see the bonus is fully vested at the end of year 10. So now these columns match side by side moving forward. Okay, so that's going to wrap up this review for the F&G Accelerator Plus 10 fixed indexed annuity. Again, if you like this video, you've gotten some value out of this review, please do us a favor and give us a thumbs up and share this review with some of your friends and family that could also benefit. When you do so, it helps our videos rank higher for others looking for similar information to help them make an educated decision. If you'd like to work with me directly, I'd be honored to do so. I work with clients in all 50 states. I utilize a secure Zoom platform to meet face-to-face using a video connection. And you can visit our website at annuityassociation.com. Right there on the main page, click the green button to request your free report, and I will reach out to you in a timely fashion to see how I can help point you in the right direction. So thanks so much for watching. Hope you have a great day and take care of one another. This is Jeremiah Conger from Annuity Association signing off. Thanks so much. Bye-bye.